Every year, around April, millions of high-earning professionals look at their tax software and make a split-second decision. They see a massive balance due to the IRS, realize they haven't maxed out their traditional pre-tax 401k, and immediately funnel the maximum allowable limit into the account. On paper, it looks like a flawless financial victory. You instantly shave thousands of dollars off your current year's tax bill. Your employer might hand you a matching contribution, and you get the psychological satisfaction of watching your net worth grow in a tax-sheltered bubble. It is the single most celebrated piece of conventional financial advice in America. But if you are a career professional between the ages of 30 and 55, this exact decision might be setting a massive, mathematically predictable trap for your retirement. The paradox of the traditional 401k is that the better you are at investing, the more expensive this account becomes. By trying to escape a moderate tax bracket today, you may unknowingly be forcing yourself into the highest tax brackets of your life during the exact years you are supposed to be enjoying your financial freedom. To understand why this happens, we have to establish a clean, standardized playing field based on the structural rules of the United States tax code and historical economic realities. For our analysis today, we are going to look at the math through the lens of a standard upper-middle-class professional trajectory. Let's assume an average filing status of married filing jointly, utilizing the standard deduction, which according to the Internal Revenue Service stands at $29,200. We will assume a baseline long-term inflation rate of 2.5%, which closely aligns with the Federal Reserve's long-term target and historical CPI data from the Bureau of Labor Statistics. When we discuss market growth, we will utilize the historical benchmark of the S&P 500, which has delivered a nominal annual return of approximately 10% over the last century, translating to roughly a 7% real inflation-adjusted return. Finally, we must baseline current tax brackets. Under the modern Internal Revenue Code, a joint filing couple earning between $100,000 and $200,000 finds themselves firmly in the 22% marginal tax bracket, while income shifting above $200,000 enters the 24% bracket. It is within this specific framework that the conventional wisdom of the traditional 401k thrives, and it is also where the hidden math begins to compound against you. Let's look objectively at why the traditional 401k looks like the absolutely correct choice to almost every rational investor. The primary psychological driver here is what behavioral economists call present bias, our natural human tendency to overvalue immediate rewards, like a tax refund today, while heavily discounting future consequences, like a tax bill 30 years from now. And to be completely fair, the immediate rewards are highly compelling. When you contribute $23,000 into a traditional 401k while sitting in the 24% marginal tax bracket, you save exactly $5,520 on your current year's federal income tax bill. That is cash that never leaves your pocket today. Furthermore, the concept of tax-deferred compounding is mathematically elegant. Inside a traditional 401k, your investments grow completely unhindered by dividend drag or capital gains taxes. If you rebalance your portfolio, sell an equity mutual fund, or collect a corporate bond yield inside that account, you owe nothing to the federal government in that tax year. This creates a massive compounding tailwind over 20 to 30 years. The core thesis of the traditional 401k relies on a simple foundational assumption. You are saving money at a high tax bracket today during your peak earning years, and you will withdraw it at a much lower tax bracket in retirement when your income drops. It is a beautiful, logical strategy that feels completely secure. It feels like you are winning the game. But the real math shows that this foundational assumption contains a structural flaw. Here is what changes the whole calculation. When you pull money out of a traditional 401k in retirement, the IRS does not treat it as capital gains. They treat every single dollar as ordinary income. Most people miss the fact that they are converting what could have been highly favorable long-term capital gains tax rates, which top out at 15 or 20% for most investors, into ordinary income tax rates that can scale all the way up to 37%. Let's peel back the hidden costs layer by layer. The first layer is the compounding tax debt. When your traditional 401k grows from $100,000 to $1 million, you haven't actually made $1 million. You have built a joint venture with the IRS, where they own an undefined percentage of your total balance. You are taking 100% of the investment risk, but the IRS maintains a permanent lien on the upside. The second layer is the structural mechanics of required minimum distributions, or RMDs. According to IRS rules, once you reach age 73 or 75, depending on your birth year, the government legally forces you to withdraw a specific percentage of your traditional retirement accounts every single year, whether you need the money or not. If you have been a diligent, highly successful investor who maxed out their pre-tax accounts for 30 years, your RMDs alone can easily top $100,000 a year in forced ordinary income. This brings us to the third and most destructive layer, the tax torpedo effect. This forced ordinary income doesn't just get taxed on its own. It acts as a catalyst that triggers a cascading chain reaction across your entire retirement portfolio. Under Social Security Administration rules, if your combined income crosses a modest threshold of $44,000 for a married couple, up to 85% of your Social Security benefits suddenly become subject to federal income tax. Furthermore, this artificial spike in ordinary income triggers IRMAA, the Income-Related Monthly Adjustment Amount. This is a progressive surcharge levied by the Centers for Medicare and Medicare Services that dramatically increases your Medicare Part B and Part D premiums. A single dollar of excess RMD can push you over an IRMAA bracket threshold, instantly costing you thousands of dollars in unexpected healthcare expenses. You aren't just paying tax on the 401k withdrawal. That withdrawal is actively destroying the tax efficiency of your entire lifestyle. To truly comprehend how a small decision today alters your life trajectory, we must run a long-term mathematical simulation. Let's look at a 35-year-old corporate professional who decides to max out their traditional 401k at $23,000 per year for the next 30 years, intending to retire at age 65. We will assume their account grows at a standard 7% real inflation-adjusted return to keep all figures in today's purchasing power. Let's track the checkpoints. At year 5, the strategy looks flawless. The portfolio has grown to roughly $131,000. The investor has successfully deferred over $27,000 in federal income taxes. They experience a profound sense of validation. By year 10, the portfolio hits approximately $316,000. The tax savings have crossed $55,000. Mental accounting, the psychological phenomenon where we treat money differently based on its origin or destination, convinces the investor that this deferred tax is purely free money they have saved from the government. Now, let's look at year 20. Thanks to the power of compounding, the account balance swells to just over $1 million. But here is where the hidden weight of the tax debt becomes massive. At a 24% assumed tax bracket, a full $240,000 of that balance does not belong to the investor. It belongs to the IRS. Finally, let's look at year 30, right at retirement age 65. The traditional 401k balance has reached an incredible $2.2 million in today's purchasing power. The investor feels wealthy. They prepare to execute a standard 4% safe withdrawal rate, which yields $88,000 a year. But look at what happens next. When they add their projected Social Security benefits of roughly $60,000 combined for a married couple, their total retirement income sits at $148,000. Because that $88,000 from the 401k is taxed as ordinary income, it fills up their standard deduction and pushes them straight into the federal tax brackets. According to the Social Security Administration's formula, this income level automatically triggers the maximum 85% taxation on their Social Security checks. Then, at age 75, the RMD mandate kicks in. The IRS forces a dynamic withdrawal factor of roughly 4.1%, requiring a first-year mandatory distribution of over $90,000. Combined with Social Security, their forced income jumps to over $150,000. They are now pushed into higher tax brackets during retirement than they were in during their working years. They are trapped paying ordinary income rates on a massive nest egg while facing elevated Medicare premiums via IRMAA surcharges. If they had instead utilized a Roth 401k or a standard taxable brokerage account subject to capital gains, their qualified retirement withdrawals would be entirely tax-free, keeping their provisional income low enough to completely protect their Social Security benefits from taxation. Please note that this simulation is for educational purposes, based on historical averages and current tax structures. It is not personalized financial advice. You should always consult a certified financial advisor to analyze your specific household situation before making major structural adjustments to your retirement strategy. To maintain total analytical fairness, we must acknowledge that the traditional 401k is not inherently flawed. It is simply a tool that requires specific conditions to win. The traditional pre-tax strategy wins decisively under 3 scenarios. First, if you receive a highly generous corporate match, you must always contribute enough to capture the full match. That is an immediate 100% return on your capital that outweighs any future tax drag. Second, if you currently reside in an exceptionally high tax bracket, such as the 32, 35, or 37% brackets, and you plan to relocate to a state with zero income tax in retirement while intentionally living a highly minimalist, low-expense lifestyle, the tax arbitrage works heavily in your favor. Third, if you face severe cash flow constraints today, where the choice is either taking the pre-tax deduction or not saving for retirement at all, you must always choose to save. The higher-level financial principle we must draw from this is simple. True financial freedom requires tax diversification. Just as you do not put all your capital into a single stock, you should never put your entire retirement future into a single tax bucket. Relying solely on a traditional 401k exposes you to systemic legislative risk, the risk that future tax rates will rise to meet national debt obligations. By balancing pre-tax accounts
and taxable brokerage accounts, you gain total control over your income streams, allowing you to manipulate your reported income in retirement, legally bypass forced distributions, and protect your hard-earned wealth from the hidden cliffs of the modern tax code.